Hello, everybody. My name is Nicole and I'm a technical analyst and private investor. And today I thought I'd look at the yield on certain government bonds, because everybody is speculating at the moment just how many trillions of dollars Mr. Biden is going to throw at the problem. It's all speculation, of course, it always is. But the problem is very big indeed. So don't, if it's big numbers, don't worry. But inflation is not a big problem in the States, or in fact, in most places in the world. That is not the problem, despite all this money printing and despite all the simple equations that economists tell you that printing money leads to inflation. It hasn't. It hasn't, not yet. There is a little bit of food price inflation here and there, but that's about it. So let's get practical. My first chart is of the yield of the benchmark US 30-year Treasury bond. This is the one which sets US mortgage rates, so it's terribly, terribly important. Now, this week, well, in fact, yesterday, well, the whole of this week, the US Treasury has been holding regular auctions. And yesterday, they sold off a nearly record $24 billion worth of the 30-year paper. New 30-year paper. It was immediately snapped up by non-competitive bidders, competitive bidders, and primary dealers were left with a meager 14.2% of the issue. In other words, primary dealers don't have a cash kitty. They don't have nearly enough stock for the day-to-day trading needs. So there we've got a problem. Anyway, looking at the weekly chart, you can see that the downtrend line has been broken, no doubt about that. But that's because we're going sideways. We're going sideways in a sort of giant triangle channel sort of a thing. So anything that goes sideways will break any diagonal line always, and it's not especially significant. In fact, the break is suspect in my view. And I put this recent, very quiet, steady movement down to a period of consolidation under what had been the record low for 2019, under the record low for 2016, and about the Fibonacci 38% retracement from the interim high late 2018. So it's just consolidation. We've ducked under it this week. We'll see where we close. We'll see what happens. But I think all the hype about yields going higher is probably incorrect. At best, they'll stay where they are. Possibly they'll drop to new lows this year. This is not going to happen tomorrow. This is not a panicky market yet. My second chart is also a weekly one of the yield on a 10-year benchmark UK gilt. And like the US bond, you can see that by moving sideways, we've broken sort of attempt to break the diagonal line, but we're well within an established range here. The yield is a measly 30 basis points. So it's no wonder that it's finding it difficult to drop to new lows. Very much the cloud is pushing it down. I expect gilt yields to drop. My third and final chart is of the German Bund. It's a variation on the theme, as you can see. The cloud's a mess because we're going nowhere, and we're going nowhere because we're already at negative 53 basis points, negative 53, and there's been no change since late 2019. So this is still in a downward path, in a downward trajectory, and what we've been doing for the last year or so is consolidating. Keep on looking at these. These are terribly, terribly important for all of us each and every day. Good trading, and I'll see you next week.